Hello and welcome to the latest edition of Citrus Bites, live from our offices in Sevenoaks. So big day today from a central bank perspective, with the Bank of England following on from the ECB, the European Central Bank, and most recently the Federal Reserve in the US with their interest rate announcement. Expectations were, I would say, mixed with regards to whether we were going to see a drop today, given that the ECB did drop last week and the Federal Reserve came out probably with a slightly bigger than expected 50 basis points reduction in the target key lending rate within the US. So with expectations like that, what did the Bank of England decide? Well, the Bank of England Monetary Policy Committee have decided to leave rates unchanged, with the Bank of England base rate at 5%. So why, when we're seeing rates change kind of in European Central Bank and in the US, why is it that the Bank of England decided that leaving rates unchanged was the right approach for the UK? So let's have a look at this. GDP, so if you like, the size of the economy. So we knew that that was flat for June and for July. So that's at that point when the narrative around the interest rate situation was, well, maybe it's time for another reduction. Maybe the UK economy isn't in such great health. But as we know, the central banks like to use data. So just want to look briefly at the rest of the data now to go, so what really might have driven that decision? So let's start with something I always talk about, inflation. CPI. CPI on a 12-month rolling was flat at the end of August compared to the 12-month rolling to the end of July. So that was flat at 2.2%, marginally outside of the bank's target of 2%, but only marginally. It's worth remembering, October 2022, for those that can remember, we were talking double digits, over 11% in CPI. Now we're talking 2.2, but still just ever so slightly ahead of that target rate. For those of you that watch Citrus Bites regularly, you will know that for month after month after month, I've talked about core inflation, core CPI, and here is one of the challenges. So core CPI, I've always referred to as sticky inflation. So for those perhaps not familiar with the core CPI terminology, it excludes food, it excludes energy, it excludes things like alcohol and tobacco, because typically they are very volatile and can therefore distort the number quite significantly quarter on quarter. So core CPI was up to 3.6% on a 12-month rolling. It's actually up from the previous report. So the previous reporting was 3.3 on a 12-month rolling, but to the end of August, it went up to 3.6%. So that's not great news, because that's the sticky inflation, and the Bank of England will be very focused on that number continuing not to increase. So if we're seeing kind of the economy relatively flat, if we're seeing CPI inflation broadly only just above the Bank of England target, what's driving the core inflation to continually see this increase? Well, I've talked forever about service sector inflation as well, and that was the thing that jumped again. So up to 5.6% in August from 5.2% in July. Why? One of the biggest reasons this changed and went up was airfare increases, and particularly airfare travel across Europe. Now, you may say, well, of course, Richard, it was the summer, peak summer holidays, airfares are going to go up. Well, they did go up, but there's a couple of really interesting things that influence this. Number one, we know it's the peak summer period, but even against that, this was the second highest reading recorded since they started this monthly data back in 2001. So even against all the normal summer trends, airfares were up significantly on the month, 22%. And the other point is that I talked a few months ago, I think I talked about the price of oil and therefore the price of jet fuel. And you may have noticed that actually oil price has gone down. You may have noticed that at the pumps for those still using it, that petrol price have dropped a bit. So you'd expect jet fuel to also mirror that. Well, actually, bizarrely, although airfares overall are included in core CPI, because jet fuel fits the box that I said earlier as being a fuel, it's therefore excluded. So here we go, data. But that's one of the biggest influences we had in the most recent reporting as to why core CPI has gone up, airfare. So there you are. So we may well see that number change again quite significantly over the next few months. As always, I'll bring you those numbers on CPI as soon as we can get them from the reporting with the Bank of England announcement. So we know that core inflation is a challenge. Let's look briefly then. I talk about a couple of other areas regularly. Average weekly earnings. Average weekly earnings, May to July, annual growth. So from the May to July period, the reporting figure is 5.1%. It's still high. So remember, I've just talked about inflation at 2.2 or core being at 3.6. So average weekly earnings excluding bonuses are still running over 5%. So we're still running quite well ahead of inflation on those pay awards. Great if you can get those clearly. And actually, if you're in the public sector, so we know, for example, some of the pay deals that have been negotiated, for example, with doctors recently, if you're in the public sector, that figure is actually 5.7%. So the Bank of England is now looking at the average weekly earnings figure, still healthy. And the last thing I tend to talk about is unemployment numbers and vacancies. We still have vacancies totaling over 800,000 in the UK. So these are job vacancies over 800,000. Now, it is quite significantly down from the over 1.3 million we saw some months back. But nonetheless, in spite of those job vacancies, the pay negotiations, excluding the public sector, they are starting to ease slightly, albeit I just said still quite strong. And unemployment is relatively flat. So unemployment at 4.1%. So actually, when the bank is looking at the rest of the dials, they're going, unemployment's holding relatively steady. Job vacancies are still there, but we're starting to see an easing of some of the really kind of significant pricing pressure on average weekly earnings we were seeing a few quarters ago when the job vacancies was over 1 million and employers were fighting really hard to get the best talent. So there are signs that easing slightly, but they're still quite strong numbers. And the CPI, core CPI, is still a strong number. So you put all that together, and the Bank of England have decided that this time round, from a UK perspective, they're going to leave rates unchanged. Can I give you any good news? Obviously, there is some good news in there for some of those statistics. The other one, probably, let's talk about sterling for a second. Why does it matter? Well, the strength of sterling is good because the economy is seeing quite, in some ways, quite buoyant, because even though GDP is flat, rates have been held. Well, if you're going to use that sterling and convert it into dollars because you're going somewhere where they take dollars, the good news for you is you can get more dollars now for your pounds than you could have done a couple of months ago. So that's one positive I can give you. There we are. That's probably it for today. I hope that's given a good enough overview of the Bank of England rate decision. The next rate decision of the 7th of November, as soon as we get that rate decision, I'll have another video and let you know what the outcome is. Until then, thanks for watching and bye for now.